On February 7th, the Reserve Bank of Australia, the RBA, raised its cash rate 25 basis points up to 3.35%. This was the fourth consecutive 25 basis point hike, making the rate the highest level in over 10 years. Though the market had anticipated the move, the outliers seemed to be the ramp-up of hawkish rhetoric as the RBA Governor Philip Lowe reiterated that the bank remained committed to doing what is necessary to reduce the inflation back to the 2 to 3% target. Now, this comes after the last read of Australian CPI came in at 7.8% on January 24th, higher than expectations of 7.6%. After the hike, the Australian dollar rallied over 1%, reversing some of the weakness in recent days, but has it up almost 12% against the dollar since putting in a cycle low in mid-October. Of course, part of the over 15% move higher against the dollar from October to early February was an anticipation of the reopening of China, Australia's chief export partner. Now, the next important economic data point in Australia will be the February 15th read on the unemployment situation. This data is critical in giving an indication how the underlying economy is dealing with the rapid increase in borrowing costs. Now, additionally, the currency pair will be heavily affected by the next release of U.S. CPI on February 14th, and that should give us some direction as to the rate path of the U.S. compared to Aussie. Now, the CME Group offers three different size currency contracts, the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We're going to be using the micro in these examples. If a trader believes that the move toward hawkishness from the RBA could push the Aussie dollar higher, they could express that by buying the March micro Australian dollar futures contract at 0.6933 and target a move back to the cycle highs at 0.7160. A stop for this trade could be placed below at 0.6825. This trade could make $227 if the target is reached and risks $108 if you're stopped out at your level. Now, if a trader believes that the Aussie dollar could fall from here, perhaps based on a newly hawkish Federal Reserve in light of the recent hot jobs data, they could express that by selling that March micro Aussie dollar futures contract at 0.6933 and targeting a move to the December lows of 0.6660. A stop would be placed above at 0.7100. This trade can make $273 if the target is reached and risks $167 if you're stopped out at your level.